Hello and welcome to Pensions 101, a series designed to help you make sense of your pension. My name is Martin and today we're talking about the two main types of pensions in the UK, defined contribution and defined benefit pensions. Defined contribution pensions are the most common type of pension. In fact, most modern workplace and personal pensions are defined contribution pensions. Typically you and your employer, if it's a workplace pension, make contributions each month. These contributions are invested into a range of assets such as company shares, property or bonds. And the amount you receive in retirement depends on how much you've paid into the pot and how well your investments have performed over time. The personal contributions you make into defined contribution pensions will usually qualify for tax relief from the government. Basic rate taxpayers usually get a 25% tax top-up. For example, if you paid £100 into your pension, you'd get an extra £25 from the government, meaning that a total of £125 would be invested into your pension pot. Higher rate taxpayers can claim further tax relief on their pension contributions through self-assessment. At retirement age, one option is to use a defined contribution pension to buy an annuity, which will pay you an income for the rest of your life or a fixed number of years. Alternatively, you can simply draw down your money as you wish, subject to tax. The current retirement age for defined contribution pensions is 55, rising to 57 by 2028. Defined contribution pensions are usually held outside of your estate for tax purposes, which means your beneficiaries won't have to pay inheritance tax when you die. If you die before the age of 75, your defined contribution pension can be passed on to your beneficiaries tax-free. If you die after the age of 75, your pension beneficiaries will have to pay income tax at their marginal rate. PensionBee can combine and transfer your old pensions into a brand new plan that you can manage online. All of our plans are defined contribution plans and they're managed by some of the world's biggest money managers. Now we're going to look at defined benefit pensions. A defined benefit pension, also called a final salary pension, is a type of workplace pension. At retirement, the value of a defined benefit pension is based on how long you've worked for your employer and promises to pay a retirement income based on a percentage of your salary. With a defined benefit pension, your employer is responsible for making sure there's enough money in the scheme to pay you when you reach retirement. If your employer gets into financial difficulty and can't meet its pension commitments, the Pension Protection Fund will usually cover your pension income, but you may receive a lower amount than you were promised by your employer. Defined benefit pensions are increasingly rare, but you may have one if you've worked for a large company or a public sector organization. Some of these pensions are funded, which means you can get a cash value for your pension and transfer this amount to another provider should you wish. Before making any decisions about a defined benefit pension, it's important to understand that you will lose any guaranteed or special benefits promised by your employer if you transfer your savings to a different provider. Instead, your pension money will be invested into a defined contribution plan, and the amount it's worth on retirement will be based on how much you've contributed, which includes the amount you transferred and how the investments have performed over time. If you have a defined benefit pension that's worth over £30,000, you'll have to consult an independent financial advisor, IFA, before moving your pension. If you're in an unfunded public sector pension scheme, such as an NHS pension, a teacher pension, or a civil service pension, you won't be able to move your retirement savings. That's because this type of pension uses a pay-as-you-go system. This means that your employer doesn't set aside money for employee pensions. Instead, they use contributions made by current employees to pay pension benefits to retired employees. Usually, a defined benefit pension promises a retirement income beginning at a specified date, with pension income usually increasing each year in line with inflation. Normally, you can pass on a percentage of a defined benefit pension to your partner or dependents when you die. Under new pension rules, you can take 25% of your pension as a tax-free lump sum when you reach 55, or 57 by 2028. This is quite straightforward if you have a defined contribution pension, but when it comes to defined benefit pensions, it can be complicated. If you want to take a tax-free lump sum from a defined benefit pension at retirement age, your pension provider will reduce the retirement income you're due to receive based on how much you've withdrawn. Make sure you contact your pension provider for more details if you're considering this option. Remember that pensions are an investment. Like all investments, the value of your pot can go down as well as up over time. Your capital is at risk. For more information on pension types, visit our Pensions Explained Centre. Thank you for watching. If you have any questions, please leave them in the comments below. Don't forget to like, share and subscribe to our YouTube channel. See you next time.